Good afternoon, or maybe good morning, ladies and gentlemen, wherever you've joined us from, and welcome to today's joint event between the REITs Association of Kenya, or the RAK, the Kenya Association of Stockbrokers and Investment Banks, or KASIB, as they're commonly known, and the FMA, the Fund Managers Association, and the CISI as well, Chartered Institute for Securities and Investment, where we will be discussing the key principles of basically REIT investment theory, valuation and return, and touch a bit on the Kenya REIT performance as well in relation to the market and the future of REIT investment as well. And to note, this is the first of a three-part series that will delve deeper into the REIT space towards enhancing knowledge and expertise within REIT investment, management, and the real estate market as well. My name is Gathogo from the CISI, and I'll be your host for this event. And the key questions we'll be asking ourselves today. So what exactly are the fundamentals of investing in REITs? Who should invest in REITs? Okay, what are the key items that a REIT promoter or investment bank should consider when putting together a REIT offer for investors? Okay, and a host of other questions as well. And to expound on these issues further and bring out that critical learning objective, we are joined by a very knowledgeable trio, starting with Dan Gathogo. Now, Dan is currently the Deputy CIO, the Chief Investment Officer at Sanlam Investment East Africa. And prior to this, he served as a Senior Portfolio Manager and Investment Manager at the same institution. And prior to this, he served as an Investment Analyst at Pinebridge Investments. Welcome, Dan.
Thank you, Kimasha, for that intro. Really quite happy to be speaking to the audience here. As you heard, my name is Dan Gathogo, and this is the first of a three-part series. And we'll basically be taking sort of an intro within the REITs market. We'll give an overview of some of the REITs that we have in the country, as well as give comparisons of the REITs market here and the REITs market in South Africa. Thank you, Kimasi, and looking forward.
Okay, thank you, Dan. Next up, we have Ewart Salins. Now, Ewart is currently the Chief Executive at Apollo Asset Management Company. He has over 2 decades experience in the capital markets, having started out his career as an actuarial consultant with Hymans Robertson, now currently Zamara, before transitioning into investment banking, working with Africa Alliance, Kestrel Capital, Dry Associates, and all mutual and various capacities. He's also currently a director at KASIB, the Kenya Association of Stockbrokers and Investment Banks, and a member of the FMA, where he chairs the Alternative Investments Committee. In addition, he sits on the steering committee of the KEPFIC, Kenya Pension Funds Investment Consortium, tasked with pushing the alternatives agenda, investment agenda, within the retirement benefits industry. Welcome, Ewart.
Yeah, good afternoon, Kimasia, and good afternoon to everybody. I trust the first of 3 webinars will be useful to everyone. I think we start off with the basic steps in this webinar, and then we move on to fairly more complex things in numbers 2 and numbers 3. So yeah, looking forward to it as well.
Okay, thank you, Ewart. And next up, we have Zorava Singh. Now, Zorava is the managing director of iJenga Housing, an affordable housing development, finance, and management company based in Kenya. He also serves as a director at the Kenya Property Developers Association, where he chairs the Affordable Housing Task Force and leads the REIT Toolkit and Incubator Program at the REITs Association of Kenya. So previously, Zorava served as a GM, General Manager of Agriculture and Equity Group Foundation. He's also Chief Executive of the Community Lab at the Earth Institute at Columbia University, where he focused on health system strengthening and integrated development. And prior to that, Zorava was a real estate investment banker at Merrill Lynch and started his career as a technology and management consultant at Accenture. Okay, and Zorava received a BCom in operations management from the University of Alberta and an MBA in real estate and finance from Kellogg School of Management at Northwestern University in the US. Welcome, Zorava, beautiful CV.
Thank you so much, Kamasha. I appreciate it very much, and excited to be here today and joined by very capable panelists, and appreciate this collaboration between the REITs Association of Kenya and CC. It's an exciting webinar series that we have planned, and maybe I can just set a landscape for that as we chart our way forward today and jump into the topic. This webinar collaboration is a three-part series, as we've heard. And the idea being is it's a part of our program to stimulate, mobilize, and educate the market on REITs. This is a part of our REIT Toolkit and Incubator program that has been running for the last year or so. The program started in early 2023 with just a concept, and then we secured funding and support from the Joint Capital Markets Group at the World Bank. And we hosted our first few events, which is a part of the program development series. So last July, we kicked off with the first event where we were mobilizing. And then in November, we started walking through the detailed toolkit. The toolkit is basically a set of tools that are for the service providers in the sector. So for the investment bankers, for the lawyers in the sector, to help facilitate an easier registration of new REITs. So there's templates like financial models, investment memorandums, legal templates as well, and all of them to really help support the application of new REITs in Kenya. All of those tools are mapped to a standardized registration process that's linked to the CMA applications. And so we're really there to help mobilize and make efficient the application process. The REIT Incubator is an incubation environment that supports the incubation of new REITs. We currently have 6 REITs in the incubator process, which we'll talk about a little later on. And they span from housing, industrial, private sector, public sector. And that program is really helping to bring REITs to market by assisting them through the journey, introducing them to capital, and unlocking any bottlenecks. This 3-part webinar series is going to touch on various aspects of REIT and REIT management. So today's conversation is going to talk about REIT investment. And we're going to talk about the principles and the theories of REIT investments and touch upon some of the data that we have here in Kenya so far. We'll find that it's still a new sector, so the data is still being developed, we can say. We did look at South Africa as a case study, and we're excited for our very capable speakers to be talking about some of that. The next session is going to focus on REIT management. So this is where the rubber meets the road. The REIT manager is where you have to make investment decisions on assets, which buildings to buy, which strategies to pursue. Is it a Nairobi-focused strategy? Is it across Kenya? Are you focusing on housing? Is it industrial? Is it a diversified asset pool? And really looking at real estate as the underlying. And that leads us to our third webinar, which is going to focus on real estate asset classes, understanding the nuances between housing, industrial, commercial, hospitality, and some of the other specialized real estate asset classes like healthcare, education, real estate as well. And that deep dive is going to really help us understand how do we get to the underlying asset, the valuation, and the market readiness of the REITs. So today we're excited to kick off this webinar series and very thankful for our host today, Cici, and the great speakers we have from FMA.
Okay, thank you, Zorava. And just before we begin, let's just a bit of housekeeping, especially for those who are new here. Now, look at the bottom of the screen, you'll see a set of buttons. The most important is actually the Q&A. So we use that to type your questions and submit. You may also use the chat to forward your comments. We'll see it on our end. We may not have enough time to go through all the questions, but we'll certainly try and do what we can. Nonetheless, we urge, keep those questions coming. Let's make this as interactive as possible. Okay. At this point, we can share the slides. So allow me to share. Then I'll invite Dan to take it away.
And again, as mentioned, as Kimasi goes to the next slide, I think what we really wanted to get away from this first part of this webinar series is just to introduce REITs to those who may not be aware about REITs and talk about some of the drivers of REIT investments, what we've seen in other markets, and why we think REITs are important for, both from an issuer perspective and from an investment perspective. I'll talk about those first 2 drivers of investments, diversification and quality returns. And Ewart Salins will talk about the other 3. So to start with, in terms of diversification, we consider that, and next slide, Kimasia, we consider diversification as one key driver of REITs. If you look at real estate in general, compared to other asset classes like bonds, equities, if you stack them on a risk return basis, real estate, compares quite well. It's an asset class that is not volatile. It's quite a general asset class. And REIT is a way of getting exposure towards real estate in a very tax-efficient manner, and in a manner that, as we talk about the other drivers, is quite good when it comes from a liquidity perspective. But speaking to real estate in general, quite a good way to diversify. If you look at for most of Kenya pension schemes, most of the assets invested by pension schemes are basically in your traditional assets, in your fixed income, in your equities. And we've seen significant volatility, especially in the last years, post-COVID. We've seen volatility in our markets as well as even international markets as well. And real estate investments in real estates that have been done well have actually come out and performed quite well during this period. So that's a key point. Real estate in general is a diversifier, and REITs is a good way of investing and getting exposure in real estate. A key thing to point out with REITs is that, generally for a successful REIT to fundraise for investors to invest in, has to have good underlying assets. And most of these REITs that we see, that we have seen in our market, have a cash yield appreciation, and this is from a return perspective, as well as a capital appreciation. And later on, we'll talk about we'll look at a case study. We'll look at Econ Investments. They've issued a REIT that has done well so far and has both elements of a cash yield and a capital appreciation. But generally, REITs is a good way for investors, pension schemes, retailers as well, to get an exposure towards real estate. It's a good diversifier, and especially during this period when we've seen a lot of volatility from your assets like fixed income and equities. Generally, if we go to the next slide, and again, when you look at return, we normally like to compare REITs with property. And Kimasi, next slide. And generally, we've seen, REITs generally do quite well. We've got a slide here that shows that's a good case study of a market that we can benchmark with. That is South Africa. It's a much more mature market than here in Kenya. South Africa has 27 REITs that are listed in the JSE. Compared to Kenya that has 3 REITs so far in issuance. So quite a mature market. South Africa has always had property listed companies since 1999. But in most of these property listed companies were generally insurance companies and pension schemes trying to divest and trying to attract other investors and have them get exposure to property. But in 2013, when the REITs laws were enacted in South Africa, what really came out strongly for REITs, or a strong incentive for these listed properties companies to convert it to REITs, was the tax incentive nature that REITs have. Basically, REITs, for those who might know, REITs are very tax efficient vehicles. Tax friction is quite minimal when it comes to REIT as a vehicle. If you look at most of them, generally the general legislature of REITs across the world, various taxes are not, basically are not mirrored upon when it comes to REITs investment. So many of these these listed companies that were listed in South Africa converted into REITs, and we've seen significant growth in that market. If you look at that bullet point below, the average distribution yield for the REITs in South Africa is about 9.1%, and the REITs market has done well. If you look at the top right chart, we compare the performance of REITs, that is a blue line graph, versus the performance of the stock market, that is the JSE, that is the red line, and performance of bonds at the JSE. That's purely South African market stats. And what is clear is that REITs have generally done well during that period. In that market, they've done well, but a key thing to point out is that they have actually quite distribution yield. And as we continue talking about REITs in this webinar, we'll emphasize that the key for successful issuance of REITs, the key for a thriving REITs market is actually having REITs that have got good underlying portfolios. And I think that's the case in SA. The distribution yield at 9.1%, quite attractive, and with a good payout ratio of about 9%. That's quite an attractive return, and that's where REITs have done quite well in that market. I think if you look at that chart from 2019, Again, similar to other assets, REITs have also had their fair share of volatility, and these are listed REITs, but generally we are seeing, REITs are doing quite well. So hopefully it will come to a point where, the Kenyan REITs market will be, we'll have more listed companies coming out. But again, besides REITs offering a good investment option for investors, what you can see is that even for issuers, and I'm talking about insurance companies, I'm talking about pension funds, it's a good way for these institutions to actually divest out and reduce the exposure in property, as long as the underlying assets are quite well. And we've seen what South Africa has done. So that's a case study in South Africa. I think the brief of it is that South Africa is quite a mature market, has many listed companies, many listed REITs, and the performance of REITs in those markets is quite well, driven by a good cash yield. So with that, we'll go to the next slide. Having finished that element of diversification, the other element, which is a strong driver of REITs, is returns. Again, I'm speaking as an investor, given my background as an investment manager within the pension industry. There's generally appetite for property. There's appetite for REITs, but the underlying theme is that return has to be quite good. And like I mentioned before, for the REITs industry to thrive in Kenya, we need REITs that have underlying, portfolios that are actually doing quite well. But generally, what we've seen is that REITs generally, and especially those that have been listed here in Kenya, talking about Aecon as an example, just zeroing on that, have generally over the last 3 years had much better return than your general property. The general property in Kenya has not, generally, done quite well. If you look at data from the various service providers who offer, data in terms of growth within the real estate market in Kenya, property prices, there's, one of them like Has Consult. Property has generally not done quite well over the last, 4 or 5 years or so. But we've seen the current REIT investment here in Kenya as an option. Aecon has, generally outperformed that property. And the good thing about REITs investment is that ticket sizes are much smaller than, directly buying property. So, that's one good advantage about REITs. We've talked about volatility. We've seen property generally has lower volatility than the other asset classes like fixed income and equities, and we've certainly seen that over the last couple of years. Again, if you look at most REITs, most jurisdictions, including our country here in Kenya, if you look at the laws, there is an obligation for the income REITs to pay a certain level of distribution. Whatever income they get, they have a minimum payout ratio, and that is embedded in law. If I'm not wrong, I think Kenya's is 80%. So 80% of all income REITs income has to be distributed to the REIT investors. And that's a key advantage when it comes to REITs. There's that sort of regulation that governs that. Again, REIT promoters know this, investment bankers know this. For a REIT to be successful, it has to have a quality property. And, I would imagine this is a factor that before any REIT is presented to the market, the REIT promoters really will have taken advantage of. Another key advantage for REITs, as opposed to investing in property directly, is the tax efficiency. So if you look at most REITs, taxes like capital gains, most REITs are generally exempt from that. If you were to own a property directly, capital gains tax is generally eligible when it comes to, selling or not. For a number of years between 2018 and 2022, stamp duty, again, REITs were exempted from paying stamp duty, though I'm aware that the authorities had given a window of about 5 years, which lapsed in 2022. And from what I understand is that, through the REIT Association of Kenya, there's a role of lobby that's going in the background to align our REITs regulations in line with what REITs regulations are like in other parts of the world. Basically, having these REITs as tax efficient as possible. So I'm aware that there's a lot of lobby going on to have REITs not be eligible towards paying stamp duty on that. And again, from a return perspective, as long as there's that cash yield, especially from from REITs that have good property. REITs generally serve to protect properties from inflation, given that good cash return. Yeah, so if we go to the next slide, looking at taxes, just what I'd really pointed out, but just putting it in a pictorial way. REITs are generally designed to be tax efficient vehicles, generally across the world. It's one key incentive for REITs investments. And of course, that has a trickle-down effect towards return. So if you look at corporate tax, an example, and I'm talking about REITs in Kenya, no tax is eligible, at least at that REITs vehicle. The actual tax obligation lies on the underlying investors. So we see a bit of a tax efficiency with that, same as capital gains. However, the one that I think that a lot of lobbying needs to be done, I think this is work for the REITs Association of Kenya, the powers that be within REITs. I think it will be quite critical, given the sort of significant expense item that stamp duties, for stamp duty to be eliminated within the Kenyan REITs investment regulations. I think it will be quite important, and it will really help in terms of improving the attractiveness of REITs in the country. As others mentioned, REITs were exempt from stamp duty between 2018 and 2022, but that window lapsed, and there's a lot of lobbying for that. So that's me generally wrapping up. Drivers of investments. I was to talk about the first two, diversification and returns. And we think that REITs offer quite a good proposition when you look at when those two drivers are accounted on. So with that, I'll hand over to Ewart, who will talk about the other drivers of REITs. Thank you.
I think, Dan, you've got a slide on Acorn. Next one.
Thank you. Kimasi, will share the next slide. On Acorn, it's a case study. Again, for those who've, just to give a background, for those who might not be familiar with the Kenyan REITs market, we have 3 REITs that have currently been issued. We've got for ILAM for Harry REIT, was issued sometime in 2015. We've got Acorn has 2 REITs. Acorn as a promoter has 2 REITs. There's a D REIT and the I REIT. Again, they have done well, and they've done fundraising since 2021 on an annual basis. And, it's a vehicle that has continued to fundraise. And they've been quite successful so far, driven by the fact that, the underlying properties, which is student accommodation, has generally done quite well, and they've been able to deliver good yield. And we also have a REIT that was launched last year by a pension scheme. And this is what I was talking about while referring to the South African market. Many of the REITs that are listed in the South African market started off as listed firms, which started off as insurance companies and pension scheme divesting out. And it's quite a good thing to see that we have a pension scheme here in the country, that is Lab Trust, CPF, that has actually issued a REIT to try to divest some of the properties that they have. So it's quite a good thing, and hopefully we'll see many other issuers do the same thing. It's quite a good way of reducing property exposure while allowing other investors to actually, get exposure towards good property. And if you look at the Acorn I-REIT, it's what we focus on in this case study. Quite decent return. If you look at that graph on your bottom right, it shows the return over the last 3 years since the I-REIT was launched. And for information, the difference between an I-REIT and a D-REIT is simply that an I-REIT is a REIT that holds income-earning property, and a D-REIT is a REIT that generally develops property. So develops property, that's what it's development rate. So the I-REIT has delivered quite good returns since 2021. 2021, the total return was 9.4%, 2022, 8.3%, and 2023, 5.6%. If you look at the average, the compounded annual growth, 7.8% during that period, broken down into 4.5% being a cash yield. That is the actual return from, the rental inflows, net of all expenses, 4.5%, which is decent, especially given that, this was a period that, we're talking about post-COVID. For Acorn, this is a REIT that is involved in student accommodation. We all know how the student sort of landscape was like during the COVID years, many schools were shut down. So they've been able to deliver quite a good yield. And if you look at capital appreciation as well, that's a capital appreciation element that we're talking about. The average for that year, for that period, has been 3.3%. So 7.8% in a very tough environment where other asset classes like equities, like fixed income have really struggled, is quite a decent return, and really speaks to the fact that we're saying that a good REIT can help investors like pension schemes achieve diversification in a very good way, as well as achieving quality returns. So with that, Ewart, over to you with the other drivers. Thank you.
Thank you, Dan. Kimasi, if you could just have the next slide. Okay, so just going into why REITs are managed by REIT managers. I think if you were to look at the pension sector over the last few decades, at least within Kenya, dare I say in many parts of the world, most pension fund trustees would invest in real estate directly. So you have pension funds, and I'll speak from my Kenyan experience really, where if you go back 20 plus years, 25 years, you had pension funds invested heavily, a good number of them, especially the government type pension schemes, the parastatals, were heavily invested in real estate, and still are, dare I say, directly into real estate. So like, what would be the point of going through a REIT? And really, as indicated in the slide, the professional REIT managers understand the property sector a lot more than, say, a trustee would. They understand real estate investment strategy and REIT returns. So if you're going into a REIT, and hopefully a professionally run REIT, you will be buying an asset class with buildings that are fit for purpose for that REIT. We have had occasions or instances where pension funds have bought real estate directly, but perhaps that piece of property or that piece of real estate may not have suited the pension fund needs, or indeed the investment policy of that pension fund. So I think when you get into a REIT, you're quite sure that the entity you're getting into is professionally run, and it's hopefully best in class for your pension scheme as well. The next thing I would highlight are the professional costs and the overheads, which are spread across the larger portfolio. So if you're a pension fund and you've just got one or two properties, that's really all you're spending costs managing those properties, but perhaps it's just one property or two properties. Remember, with the REIT, and if the REIT has got a number of buildings in it, 5, 10 buildings, then that cost is spread across the larger portfolio. So it is far more efficient. Then again, talking about efficiency, it is a far more efficient property management structure. And then there's obviously, it's more efficient in terms of leasing strategies and the rent collection. And I think finally, in terms of reporting, and this is very key, given that ESG has become quite dominant on the scene these days, the quality of reporting by a REIT manager should theoretically, and well, not theoretically, it should be higher quality in terms of the financial aspects and indeed the ESG reporting standards versus a standalone, fund, pension fund going straight into or directly into real estate. Matt, if we could just have the next slide, please. Yeah, now this is quite a key slide as we address the ecosystem of REIT fund management. So REITs engage in several key partners in the process, including both institutional and retail investors, fund managers, and investment banks. I think what I'd want to highlight very keenly right from the start is just for this to happen, just the whole conception of it is where perhaps I think investment banks within the country, within the region, have a real part to play, because it starts off with an idea, and perhaps you may see a promoter who could potentially own 3 or 4 or 5 buildings. It's your job as an investment bank to go and speak to this owner of the buildings, this asset owner, who could potentially be the promoter, and then ask him or her whether this is an idea that they would consider. It's a way of actually releasing value in assets that one may have had for many, many years. But then if you look at this ecosystem, what is the institutional capital? Institutional capital ultimately is the pension fund that I've just spoken to, right? So that would constitute the institutional capital, the pension fund. And of course, the pension fund would then invest, they would then obviously, outsource their money to a fund manager. And then the fund manager is who will decide where to put the money in. Now, of course, there's several asset classes they can invest in, and one of them, could be a REIT. Now, this becomes very interesting. What exactly is, and who manages the REIT? And within the REITs, there are a number of parts we have to consider. So within REIT management, you have what's called the REIT manager. So at least within the Kenyan context, the REIT manager is a registered company in Kenya that holds a license issued by the CMA, the Capital Markets Authority. And their role is they're entrusted with the responsibility of providing comprehensive real estate and fund management services for the REIT scheme on behalf of the investors. So really the REIT manager plays a pivotal role in the day-to-day management and the operation of the REIT, and ensuring it complies with regulatory requirements, and it works in the best interest of the investors. You also have the property manager, and really in the context of REITs, the property manager is responsible for overseeing the planning, the execution of construction projects, that part of the real estate investment portfolio. They would look at tenant engagements. They would look at reporting, rent collection, property management services. So there are two parts really to the REIT management process. And then, of course, there's the REIT trustee. And who is the REIT trustee? They ultimately have custody of the asset. They will then obviously provide banking services. They would look at governance and the reporting requirements. And if I can just sort of speak to the box on the left, and again, I speak to the Kenyan market because that's where we're based. We project that in the next 10 years or so, the total market cap is going to be about 1.6 trillion Kenya shillings. So in US dollars, for those of you who are not in Kenya, you're looking at about 13 billion dollars by the current exchange rate. So theoretically, the REIT market could double the market cap of the Nairobi Securities Exchange as it is today. So there's huge potential in this market. The management fees for the REIT management fees, and we've spoken to REIT management, are anything at 2% of the total assets under management, which could translate into a fair amount of fees per year. Fund managers would continue to earn in Kenya that is the 0.2%, but I think there are ways in which perhaps fund managers can be incentivized to look at REITs, and that's something that we need to look at a lot more closely within the industry. And obviously, finally, investment banks, and it's the point I spoke about right at the start, investment banks can benefit from the brokerage. And dare I say, from trying to get promoters to look at this asset class in a lot more detail. Kimasi, if we could just have the next slide, please. Right, so what would be the key factors and the risk management factors of getting into REITs? And I think Dan has mentioned this before. Why would you get into it? So REIT investments are asset-backed and they're marked to market annually. So there is a bona fide asset, actually backing this property. REITs obviously hold, institutional real estate, and it's generally of much higher quality. And I think what we're seeing in the evolution of this market is that as it grows, we're seeing the properties coming up are actually very high quality, and I would say investment grade. Pretty much all properties that we're seeing being built now have this investment grade badge to it, and they're also looking to be EDGE certified or green, green buildings in some way or form. I think if you look at the Acorn buildings that have been put up over the last 3 to 4 years, if I'm not mistaken, and perhaps Zaravi, you can correct me here, they are all green buildings and probably all EDGE certified. Another factor that one would look at would be, the fact that REIT units are liquid, and they're easy to sell on an exchange. So the very fact that they're tradable, in my opinion, is a huge, huge advantage. Just getting into property and trying to get out of property is quite the Herculean task. So the fact that it's liquid is something that I think as fund managers, you would want to look at quite closely. So we've talked about liquidity. I think I've spoken to governance, which is very high, professional management, transparency. It is very transparent. No barriers to entry, so they're actually quite low. Tax efficient, Dan's spoken to it, and the dividend payout and the exit duration is pretty high. And I think finally, what we'd like to bring to your attention is, Dan, if you could just go to Kimasi, if you could go to the next slide, please. is the social and economic impact of REITs. And this really, the three things that we would like to highlight here is the urban development. So as you know, given Africa is urbanizing, I think there's been this talk within Nairobi that we will hit 10 million people by the year 2030. I think if you look at the cities of Dar es Salaam will be much more than Nairobi. Kampala, perhaps almost as big as Nairobi, if not more. Look at Kinshasa, I think that's in 30 million by the year 2030. So all these sub-Saharan cities, and especially the big capital cities, are rapidly urbanizing. And therefore, there is this need for quality, affordable housing. And I think REITs can enable cities address that gap in housing. So there's been quite a few studies around REITs and having housing REITs in particular, and affordable housing REITs. So that is something that I think over the next probably 10, 15 years, we will see develop hugely. Of course, there are the side effects that go with that. There's employment, that would be a huge impact in building. If you're going to have 10 million people in Nairobi and we're at 5 right now, you've got to create another 5 million homes. How is that going to happen? And of course, what I've spoken to earlier about the green bit contributes to some of the UN SDGs that we have put on the right of your screen there. So I think, Dan, that brings us to the end of our brief presentation. Perhaps we can just go to the Q&A session. Thank you.
Okay. Thank you very much, Dan and Ewart, for that brilliant overview on REIT investment. And yes, I believe we can now take some direct questions for the panelists and also some Q&A from the audience. And maybe Ewart, staying with you, maybe you can give us a brief about who exactly should invest in REITs. Tell us about the institutional investors, retail investors, etc. But who exactly should invest in REITs? Ewart. Okay. Is Ewart still there? Okay, I guess we'll come back to Ewart in a bit. I don't know if any of the other speakers would like to contribute to that. Who exactly should invest in REITs? Ah, there we go. Ewart is back. So Ewart, you can hear me now?
Yes, I can. Did I break off?
Yes, you broke off. So I was asking, we had the first panel question, and we're asking who exactly should invest in REITs. Maybe you can just give us a brief about who should invest in REITs, institutional investors, retail, etc.
Well, I think, to my earlier points, institutional investors without a doubt. And I think if I can just address a number of points here, I sit on both sides, on the Fund Management Association and the Kenya Association of Stockbrokers and Investment Banks. We would encourage institutional investors definitely to look at REITs because it's avoiding that risk of getting into property directly, especially if you're a smaller pension fund. I don't see why you'd want to get into property directly, and it could form quite a large portion of your assets under management. So certainly institutional investors to reduce risk, to increase your liquidity, to reduce the fact that you could be certainly overweight in property. I know this was the case for many pension funds, a decade and a half, 2 decades ago, where at the time the RBA regulations came out, the RBA standing for the Retirement Benefits Authority, many pension funds, especially the government funds, were certainly overweight in real estate by a long way. So certainly institutional investors without a doubt. And then real estate investors now have a chance to access real estate in a very tax efficient manner, and it's also very liquid. So, if you never had the millions to buy real estate in the past, you don't have to worry about that now as a retail investor, right? With your few thousands or tens of thousands of shillings, you can actually participate and own a part of real estate. So, without a doubt, there are two parts to this equation. I think it will take time before we get everybody actively participating, but I think that's just a natural evolution of the market.
Okay, thank you, Ewart. Anyone else with something to add? Maybe Dan Zoraba? Okay.
Yeah, sorry, I'll just comment in that, I think that was a fairly comprehensive sort of explanation. I'll just say that, for one of the REITs that we've seen in the market, we have seen the DFIs also be present. And I think that was the Pidge group that had invested in an Infraco that had invested in one of the REITs. And I think, through this program that we're running, the REIT token and incubator, the IFC investments arm has also expressed an interest, and I think also they have been an investor in the Fahari REIT. So I think another sort of type of investor that we might be, that might consider also REITs to help stimulate the markets and more property and capital markets are the DFIs. And over time, we might see more international pensions and institutional investors. But right now, we've seen actually currently, even if I remember correctly, and maybe Dan can highlight that, I think one of the REITs in this market has US pensions investing in it, if I'm not mistaken. And so I think overseas institutional investors could be another source of capital over time as well.
Okay. Dan, anything to add, or should we go to the next?
Yeah, Kumasi, if I can just add something there to Zarava's point. I mean, to the degree you have REITs that perhaps have ring-fenced their rent collections in, say, US dollars, right? Then any overseas investor, I mean, I'm just thinking through this loud, you'd invest on the stock exchange in KAS, but remember the rental collection, the dividend perhaps could be in dollars. So if you're an overseas investor, it would be a great diversification to your portfolio.
Okay. Thank you for that. Now let's, Zorava, let me ask you to take the lead in the next question. Basically, maybe you can elaborate on what kind of REITs are currently in the pipeline for listing in the Kenya market, I guess, Zorava.
Thanks, Commissioner. That's a great question. We've been receiving a lot of interest around the REIT incubator program and generally around new REIT registration. I will say, actually, there's almost a list of 20 different potential promoters that have expressed an interest in REITs, and they're at various stages or let's say stages of progress. We are working with a shortlisted 6 potential REITs in the REIT pilot REIT incubator program. Of those, 3 of them are focused on housing. 3 are housing REITs. One is industrial, 1 is a master planned community, and 1 is diversified different types of assets, but predominantly commercial assets. And out of those 6, 2 of them are public sector. 1 of them is a fund manager, and 3 of them are private sector organizations. So that gives you a sense that actually it's a pretty wide assortment, ranging from private sector to public sector, from housing, industrial, and commercial. And those are the REITs that are in the pilot incubator program. There are another 2-3 REITs that are sort of quite far along or moving pretty quickly on either the REIT manager's license or their actual REIT registration license. And those are also in housing, also in the diversified property as well. So we are seeing actually kind of a mixed bag. Now, on the other side of it, those are sort of REITs that are originating or maybe have active assets. There's a whole other set of conversations that we are having through the incubator program at the sector level around existing assets held by pension funds. So I think many of our fund managers and pension trustees are familiar that currently as a sector, we are almost at the threshold of what our RBA limit is in direct investment in property or a movable asset. That is a threshold amount of about 30%. And some of the research shows there's about 15 or 20 pensions that are already overweight direct investment in property. So we're looking to make a case to those pensions to say REITs is a really good way to hold property that is perhaps non-strategic assets, maybe not office buildings that they occupy, for example, but investment assets that could bring liquidity, that could bring professional management, that could bring strong governance, that could bring active reporting, that could bring renovations to those assets to increase NOI and valuations. And so there's a whole other pool of assets that are sitting that we believe can move over to the REIT sector or product as well. So that gives us a sense about who is actively in the incubator right now and how we're also trying to stimulate market growth of REITs. And the last comment I'll just make is that when we look at the slide on the history of REITs in South Africa, we saw there was a rapid increase from 2013 onwards, and we see the number of listed REITs that are there somewhere in the neighborhood. I think it was like 27 or 28, if I'm not mistaken. And so that shows us what the potential of the REIT sector is here in Kenya. We've done some high-level macro projections, and for us, it looks like it can grow up to about 1.6 trillion in market capitalization. So that's a tremendous amount of capital, and that we can have in REIT market cap. Thanks, Tamasha.
Okay, thank you, Zurava. Anyone with anything to add? Before we go into, let's take some Q&A from the audience. Some good Q&A coming in. And I guess the first one we can address is Jason wants to know. The presentation said that REITs are inflation or efficient, basically they're protected. Is that because the rents tend to rise with inflation, or is there something in the underlying rental contracts that guarantees this? Who wants to take that one?
I can take that, Kimasia.
Okay, thank you, Dan.
I think anyone can chime in, or Zurava. So basically, it's the nature of investments. If you look at REITs, and particularly talking about IREITs, in most jurisdictions, if you look at the IREIT laws, IREITs are required to distribute more than 80% of the cash flows that the underlying properties generate. So given that particular piece of regulation, you'll find that most IREITs have generally cash flow yield. And that's what we were talking about, inflation protection. And again, if you look at property as an investment, it's one of the best protectors of inflation, compared to many other investments. So generally, as in inflation, generally, inflation edges up. We normally see over a long time, rentals going up, prices of property going up. It's the nature of property. So that's the major reason as to why we say that rates and property as well in general generally protect investors from inflation. So others, I haven't seen yet a REIT that have guarantees that really, or rather contracts that really guarantee protection from inflation. I haven't seen that, but by the nature of the cash flows of these underlying properties, we see a lot of inflation protection.
Okay, thank you, Dan.
Yeah, sorry, I'll just add one more, just one comment. Is that it's the inflation protection heavily comes from the lease contract, and basically, if it's sort of for example, a commercial lease, a 5-year lease, we normally see that the inflation sort of cooked in there with the escalations, annual escalations, and then residential is often a 1-year leases, but there we also see escalations as well. And each of these property asset classes have different escalation dynamics, let's say. So often in industrial, we'll find a steady, in commercial, we'll find a steady sort of 3%, 4%, 5%, depending on what tenants are able to negotiate. In residential, we sometimes find that it's a kind of a slightly less amount, 2% to 3% in terms of annual escalations and rebasing of market rents. And so it's often found within the lease contract, which then helps it be inflation protected. So it's basically how our rents increase over time as well. Thanks. Okay,
thank you. I hope that question has been answered. I'm sure it is. Now let's talk about the target return. A couple of questions actually have come in on the target return. So one of them, so Jason wants to know, so what should a target return yield for an attractive REIT in Kenya be? Well, what is that target return? And how would this normally be split between dividend yield and capital appreciation? And let me tie that with another 2 questions also from Ahmed, and Ahmed wants to know, can you shed some light on the ROI for REITs in Kenya in 2024? and any extra figures will be appreciated. So who wants to talk about the returns when it comes to REITs in Kenya?
Well, I can start and then the other panelists can chime in. But basically, if you look at property in Kenya, I'm talking about Kenya, the generally accepted, rate of return is normally 8%. If you look at, rental cash flow, if you look at most, even how most, net operating income is calculated. So I'd say 8% is a good figure as a target return for property, for rental earning property. However, when you're developing property, for those who take that risk of developing property, the return is generally expected to be much higher. Might not have a number there, but the rule of thumb is that there's more reward when you develop. Of course, generally there's more risk, but if you get execution right, there's better reward when you develop property or you get into a development REIT. But when it comes to rental income, I think the generally acceptable yield is 8%, the target return. Yeah, so in terms of ROI, we, like Zorav mentioned, we don't have so many REIT products in the country. We only have 3. So I'd say data is not that much, but for the example that I gave, there's one REIT, the Econ REIT. They have an IREIT, and that IREIT's return over the last 3 years, the compounded annual growth has been 7.8%. So in terms of the compounded annual growth. So I don't know if Ewart and Zorav could chime into that.
Maybe just to touch upon the unique structure of the REIT that Dan's mentioning. There's a D-REIT and an I-REIT component. So there's sort of like a blended return. And it's not always the case that all REITs will be in that case. But, that there is, as Dan mentioned, sort of we have a unique element here of having a development REIT. And if a fund manager is able to invest through the development mechanism, what we find normally is that when you invest at cost, then there's a valuation lift for that asset when you move it into an income generating asset, which then goes into the I-REIT. So there is a way to sort of blend the returns, whether you do it in a fixed blend like how the Econ REIT is done, or there's another mechanism to do that. There is a way to sort of benefit from both the development return and the yield return over time as well. So that's a unique element that we have in this market of having the D-REIT and the I-REIT. And the benefit, of course, of the D-REIT is then you're still able to take advantage of the tax incentives that come with REITs. Thanks.
Okay, some great answers there. I believe that question has been answered. Now, there's a question specifically for Ewart from Lydia. So Lydia says, now you mentioned that REITs are liquid. Okay, and the question is that really the case in Kenya? The general view is that the market participation is not broad, therefore limiting the number of buy and sell. And a last comment, most small investors I know are not confident about exiting the investment when they need to. Maybe you can address the issue of liquidity of REITs in Kenya.
Yeah, I mean, that's a really good question, and it's a great concern. And, as we mentioned, the market in Kenya has literally just started. It started in 2013, so we're like 11 years into it, albeit we have not progressed as far as the South Africans, without a doubt. But I think the reason we're having these webinars, the reason we've got 6 REITs within the incubator, right? The reason we are doing all this work is to literally move this sector to a point where Lydia at some point will say, I want to sell my shares, and she can sell it at an instant, right? So yes, there are challenges. It's difficult to get in and out. So theoretically, the theory is you should be able, liquidity shouldn't be a problem. That is certainly a challenge right now. But then I would also argue the case that even if you look at just generally many sub-Saharan stock exchanges, not just Nairobi, but look at Accra, look at Lagos, look at a few. Let's exclude Johannesburg from this, right? You'd find that liquidity in any stock is tough. I remember once trying to sell $5,000 worth of Bank of Kigali shares. It took me 6 months to sell it, right? And so liquidity, I think generally in Africa is a challenge. Even if if you look at Kenya, besides Safaricom, Equity Bank, KCB, and a few others, East African breweries, and Dan can attest to this, liquidity can be a challenge. So Lydia, your point is taken. I think what we're hoping as a community is that within the next 5-10 years that we can certainly develop the sector. We can hit the 1.6 trillion that Zerav has mentioned, but over and above hitting that sort of AUM, we can even address liquidity constraints. So yes, if you were to put your money in, Lydia, would you get it out instantly? Maybe not today. It is a bit of a challenge as a retail person, but I think over time we're hoping to address it.
Okay. If no one else has anything to add. In fact, there's a second question from Lydia to Ewart. Now, do REITs really have a place in the affordable housing agenda, given that the financial criteria and return expectation of REIT investors? Let's talk about the affordable housing agenda and where it's in that.
I think, look, there are many ways to skin a cat, right? And the affordable housing agenda, and I think both Dan and Zerav can chime in here. REITs can certainly participate in part of that conversation, without a doubt. I mean, it will take a lot of money to do this affordable housing. It'll take a lot, and you certainly can't raise it from the capital markets directly. So part of it will be grants and donations. Part of it will be from the capital markets. A part of it will be through the financial banking system. But I certainly see REITs playing a small part. I mean, whether it's 5% or 10% within that conversation, I don't know. But I think in the whole affordable housing agenda, whether it's in Kenya or any other country, REITs certainly do have a part to play. It's for us investment bankers to get creative and ask ourselves, how can we address this problem? It's for us investment bankers to, once you get creative, ask the buy side and say, listen, fund managers, are you willing to look at this product? So the answer is, I think yes. The question is just how do we do it? But perhaps the other panelists could chime in here as well.
Maybe I'll comment here, and this is maybe through the lens we have at KPDA. And some of the work we're doing in the affordable housing sector. We do think that REITs has a place in the affordable housing conversation. Today when you look at let's say the market yields for residential real estate, you look at numbers like 6, 5, 6, 7%. And when we need sort of hurdle rates of 7, 8, 9%, 10%, you immediately start to wonder. But how you can make the math work is actually when we build for rental. And the interesting thing is actually most of our market here builds for a retail market, so it's a build to sell. So a developer builds a building and you spec it out with nice amenities and finishes. And what happens is that you buy the unit and then you rent it out. But when you build for rental, you build that building more efficiently. And what that means is that sometimes it's a lower spec, but still durable, still quality, still dignified living. But it is a lower cost unit. Also, you find that rental housing often is smaller than sort of commercial or residential for sale. So what happens is now your rent per square meter actually is higher. Therefore, your yield starts to get to those threshold rates of 8, 9, 10%. The third way to really drive your returns is if you have larger development schemes. So for example, if you, rather than working on a sort of infill site, which is maybe half an acre, and you pay 300 million per acre, if you go to a place that is still on a major main road, whether it be Waiyaki Way, whether it be Thika Highway, whether it be on Mombasa Road, and you're able to get a plot that is slightly larger, and you're still able to get the densities, what's happening now is you're able to have a lower cost base for that construction, but still being in an attractive area, so still being able to command good quality rents. And so, this is where the partnership between the fund manager or the investment bank and sort of the supply side, which is the developers, really comes in to really figure out what is the REIT's portfolio development strategy. And that is very key to understand how are you going to grow your REIT over time. And REITs are really meant to be ever increasing portfolios of real estate. So it's quite key to really have a strong real estate strategy so you can make sure that you can have 10, 15, 20, 30 buildings over time to grow your portfolio.
Okay, I hope that question has been answered. Okay, I'm sure it has, Lydia. So now, Jason is back. Now, Jason wants to know, do REITs release some sort of reporting on value or appreciation of the underlying capital asset? Okay, the lands or the buildings, or is the market left to determine this? Anyone?
I think I can take that. So basically, as part of the annual financial reporting, generally REITs do a valuation for all their properties. So that valuation really captures that value appreciation of the underlying assets. And it's normally reflected in, the shareholder value or the net asset value for these REITs. However, in Kenya, we do not have any listed REIT at the moment. So basically, investors normally use that NAV as a proxy for, I'd say, valuation appreciation. But in other markets, like Asia that we shared, so besides the valuation from NAV, these REITs are actually listed in the market, and they have their own, market movement, and that's what investors pegging when doing the valuations within their portfolios.
Okay. Okay, I hope that question has been answered. Now, Kelvin has a three-part question. So, first of all, so given the expense ratio of REITs, especially for like that of Akon, now, question one, is there a way of cutting down the timeline for pension funds and qualified investors to basically to cut the time down and start reaping returns in the medium term? So that's question number one. And then question number two, what are the average timelines for REITs in Kenya commencing the payoff? And then third is a question about greenwashing and reporting metrics on ESG. Is there a way of verifying the data released in the REITs basically is actually true to avoid greenwashing? So I guess we can start with the first one about the timelines for the REITs. Is there a way of cutting that down so that returns can be reaped earlier basically in the medium term? Who wishes to take that one?
Maybe I can just quickly talk about it from a construction standpoint, and then maybe my colleagues on the fund management side can talk about it from an investment mobilization standpoint. There's interesting construction technologies that allow us to really accelerate the pace of development. I'll kind of just talk now with our market norm, and then I'll talk about the benefit of having your institutional capital lined up. So today, let's say you're going to put up a 10-story building. Every floor of that building usually takes about a month or so, because now, the way that we cure our cement, our slabs, is, and the way we build up our walling is basically that's our current sort of timeline or so. So a 10-story building will take 10 months for the shell and core, the structure to come up. Then there's a period of time for fit out. And of course, we have to add on the substructure work, the basements or excavations, etc. So that's why a building like that might take 18 months to 2 years to construct. Now, the reason why developers are okay with that is because it takes time to sell those units retail. So, you might have 15, 20% pre-sales, then you're selling during the construction period, and then you're okay with that sort of 18 to 24 month period. In contrast to REITs, because we know that the REIT is going to own the entire building and is going to put that building up for sale. Now, what you want to accelerate the time of construction because you want to get that building up and running as quickly as possible. So if you move to a reinforced concrete building structure, you are now talking about 1 to 2 weeks per floor. So you can drastically reduce the amount of time it takes to build the building because you have the capital already, let's say, right? So, you know, you mobilize your capital early on in. And now you don't have to worry about selling your units, because the challenge in this market right now is mortgages are not really quite liberalized yet. It's difficult to sell units, but to move a renter from one building to another building, the friction of moving a renter is much less than renter to buyer. So now you are confident that you're able to fill up your building with new renters. So actually, by the time we start moving at scale, we expect to see the developers working with REITs to be moving using alternative building technologies and moving at a much faster pace. And so there is a way to sort of accelerate the returns basically as well. Now I think on the fundraising standpoint, maybe Dan and Ewart can talk about track record and how it's easier maybe for, you know, to raise money when you've got a bit of a track record and versus sort of, you know, fundraising timelines that could be longer or whatever it is. But that's just from a construction standpoint. Thanks.
Okay. Dan, you want anything to add? We also have another question. Basically, what are the average time? I don't know if you had mentioned this in your answers, or rather, what are the average timelines for D-REITs in Kenya commencing the payoff? Do we have average timelines?
Yes. So in terms of, we only have one D-REIT in Kenya. So again, back to data being limited. And the current D-REIT that we have is the Econ D-REIT. That's only that we have. So as far as I know, they have not started paying off dividends. And, you know, they fundraised, the initial fundraise for this D-REIT was in 2021. And I think the major reason here is generally because of opportunity. So I would think for them, for their case, is that they still continue to see more opportunity within the space that they have. So what they sell, they reinvest that back into other projects. And I would imagine that would be the case with other D-REITs. As long as opportunity is there, there would be an incentive to retain back and not distribute, basically. So that's a major reason as to why I would imagine Econ have not distributed yet. They still see a lot of opportunity. So they're just reinvesting capital.
Okay. I guess more data is required to answer that question more comprehensively. Now let's talk about verifying data released in REITs, basically for the purpose of ESG reporting and greenwashing. Okay, because the third question ideally was greenwashing and reporting metrics on ESG. How do you verify that the data, basically the data released in the REITs, to avoid this kind of scenario, the issue of greenwashing? Anyone?
Maybe I'll just talk about it from a kind of a construction, green construction certification. And then if there's any other sort of, you know, certifications that are required, you know, Dan and Ewart can mention. So from a construction standpoint, there are sort of different green certifications. There's IFC Edge, there's LEED, there's Green Star. Basically, each of these certifications are first done from a design perspective. And then by the time you build your building or your asset, you then have to have a verifier to sort of then go back and verify that they are compliant with the standards that are met. And that's for them to be able to keep their certification. And so in construction, there's pretty like clear certification guidelines and methodologies and tools that are out there, so such that people don't sort of, you know, claim green buildings in the case where maybe green buildings aren't being built. And so I think that's kind of the main way, as I understand it, for a REIT to be green, is that the underlying asset needs to be green certified, and those are the main sort of certifying bodies.
Okay. I hope that question has been answered. Actually, that's all three. Thank you for the question, Kelvin. Now let's. I think there's another good question here from Gladys. Now, glad it's actually a two-part question. Now, first of all, REITs, let's talk about REITs and Sharia compliance. So are REITs considered Sharia compliant, first of all? So that's the question number one. Anyone? Maybe.
I'll just mention quickly, because through the REIT Toolkit program, we have also engaged, or we have a module, let's say, on Islamic REITs. And I think we've talked today about two of the different types of REITs we have in the market, an income REIT and a development REIT. So technically, we often say that there's three types. The third type is a Islamic REIT or Sharia compliant REIT. Although I think that that's sort of like, if I understand it correctly, it can be like a kind of a classification or a designation to either the D-REIT or the income REIT, right? So the I-REIT or the development REIT can have Sharia compliance. And basically, what you need to do is you need to bring in a Sharia compliant expert, and they will then go through the materials and develop their own sort of IM materials, investment materials, and they will certify it as a Sharia compliant REIT. And they may recommend, though, before it can become Sharia compliant, there may be some modifications to the REIT. And so it is a designation that can be achieved by a REIT. I believe, if I'm not mistaken, that the Acorn REIT is considered a Sharia compliant REIT. And so we do have a precedence for that in our market. And if you're curious about how to go about doing that, we do have an expert, Dr. Mohammed, who sits within the REIT Toolkit experts team that we can connect you to. And so, if you can feel free to reach out to the REITs Association of Kenya, and we can connect you to an expert that can help you get Sharia compliant for your REIT.
Okay, thank you, Zoraba. I hope that question has been answered. And sticking on you, Zoraba, because this one is specifically for you. So is the REIT incubator specific to Kenya? And as a comment, there's plenty of interest of REITs in Uganda. Can a Ugandan promoter join as well?
Yeah, thanks for that question. So actually, interestingly, okay, so when we've designed this REIT incubator, so far it has been here in Kenya. But because we have got support from groups like the World Bank, and we have colleagues and partners with groups like REIT out of the US REITs Association, and we collaborate with some of the other REITs associations, our goal has been over time to be able to expand this to other markets and leverage a similar platform. And that would be both through the REITs Association program on Pan-Africa REITs Association, and also the work that NSC does through its advisory arm. And so we do have a plan over time to expand to other markets. I'll give a small anecdote, actually, which is a positive anecdote, is that recently we had a panel at the East Africa Property Investment Summit, EAPI. And after that panel discussion, we had someone approach us from Zimbabwe, and they told us about how the REIT legislation had been sort of rolled out within Zimbabwe. And there are, I believe, two REITs and maybe another 2 or 3 coming to market. And they said that they leveraged the regulations from Kenya. So they were very, very supportive about the work we're doing in Kenya. And in fact, similar to the REITs Association of Kenya, they've created the REITs Association of Zimbabwe. And so, that we are seeing a lot more activity pick up on from a REITs perspective across the continent. And we are helping to drive a narrative of Pan-African REITs as well. So, that may be a plug for the REITs Association of Kenya. Please sort of like stay involved, so you'll see some of the work that's happening across the continent as it unfolds as well. And just to sort of like maybe touch upon, the value of it. A big discussion we have at KPDA, at the Developers Association and the REITs Association, is the urbanization of cities. And if you see how we have mobilized capital, a lot of it has come from high net worths. If you think about how a lot of our, let's say, residential buildings have come up, they are chama groups or high net worth family offices. The office buildings in towns and whatnot, those are institutional investors. But REITs are a great way to crowd in more institutional capital for real estate. And we know that there is a growing demand as we see more and more urbanization. There's a growing demand for institutional grade real estate, whether it be offices, whether it be hospitals, whether it be schools, whether it be industrial facilities and industrial parks. And so we are starting to see the narrative of REITs starting to pick up in other jurisdictions across the continent. And so if anyone is in any other country and wants to learn more about how to maybe collaborate, please feel free to reach out to us at the REITs Association. Thanks.
Yeah, Kimasi, if we could just add on to what Zorav is, to his points as well. I mean, it's not inconceivable for a Ugandan entity, I'm just thinking aloud right now, to join an incubator here. But, if you want to get liquidity, perhaps cross-listed in Kenya. And the reason I bring this up is, again, just from practical experience, if you look at the Bank of Kigali, which is cross-listed in Kenya, you'll find that it's far more liquid in Nairobi than it is in Kigali. I mean, that's not saying anything about the RSC, but it's just the fact that it's in a bigger market and there is a lot more liquidity. So perhaps there is a case for some of these East African REITs to be cross-listed across into other exchanges where perhaps it could enhance liquidity. I see there's a question here, which is, could you ever see a REIT product in East Africa that is priced in a single currency that promotes cross-border investment? If it is cross-listed, that would be, that would be one way of addressing, the cross-border investment, for sure.
Okay, thank you for that. In fact, I think, Zorav, perhaps what you should do is you can post maybe your number and your email address on the chat for the attendees to see, because there has been also another question about Rwanda. It's basically the same thing. How do we get started in Rwanda? And another question is another comment. We are a fund manager and would like to work it out in Kigali. What support from your side and guidance can we get from you? I guess the REIT Association of Kenya may be able to play a role in supporting the other markets within East Africa. So I guess, I don't know. You can share your contact after this, or you can post your contact in the chat so that they can reach out. They know who to reach out to. Okay, just a few other questions. Now, someone wants to know about a REIT index, or when a REIT index is going to come about. One that compares returns, something like the NASI, like the Nairobi All Share Index. Well, when is a REIT index likely to be launched so that you can compare performance, at least as a benchmark basically for performance measurement? Similar, there's also, I guess, the JSE REITs index. Anyone?
I think that's a function of product, you must. Yeah, I mean, we've got 5-6 weeks in the incubator. Look, by the time all of those hit the market, and hopefully they're liquid enough, then we'll be close up to 10 REITs within the country. And at that point in time, I don't see why not. Maybe we could start one then. It's just really a function of the product. Unless I don't know, Zorav, what your thoughts are.
Yeah, I'd agree. I think that, like, we're kind of, I think I saw that question early on in as well, like talking about, our REITs sort of tradable right now. I think we're kind of at the development phase of the sector. And if you think about, REITs as from a portfolio theory perspective, right? I think we say portfolios are more efficient when we have, more than sort of 20 to 30 assets in the basket. And so, right now we're finding that some of the REITs are choosing to start off on the USP, or what's called the unlisted securities platform at the NSE. And once it develops a kind of a critical size and mass, and the fees, the REIT management fees, the trustee fees are amortized across all those assets, and they're running an efficient portfolio, then they're looking to then move to the main exchange or the main market, which makes a lot of sense, because, like, you don't want your fees to drag on your yield. You don't want your REIT to be trading much different than your NAV. So I think that we're still very much in a kind of a development stage of the REIT sector right now. And, it's hard to tell how long that might take. But, hopefully with the increasing momentum, it's not too long. But, over time, we might see more and more then REITs move to the main market, maybe in the next couple of years. And then, see things like, indexes, rating agencies starting to cover more research, more equity research on REITs, and hopefully that all comes in. And we're trying to work actively on stimulating that. So if you're in any of those sectors, credit rating or research, and you want to collaborate, feel free to reach out to those email addresses that were shared, the REIT Secretariat, my own, or reach out to them on the phone at the REITs Association. Thanks.
Kimashi, let me also add on to that. Right at the start of this webinar, I did mention that we have about 1.7 trillion shillings worth of assets and retirement benefits, right? So that's about $13 billion. Now that number is expected to double, excluding the REITs conversation we've had today. Yeah, that number, and maybe Dan, you can correct me here, is expected to double in the next 5 years, literally. So you're looking at 3+ trillion, 3.4 trillion shillings. And that money is going to have to find a home. There's only so much you can put into government securities. There's only so much you can put into equities. And so the REIT market, it's ripe for growing because there is money out there that's looking for new homes. So I think to the degree we get it right this time around, to the degree we can structure product that's good for the buy side, I don't see why this sector shouldn't take off.
Okay, thank you. I hope that question has been answered. Now, just two more. We're out of time. We're almost out of time. Just three more quick questions, and then we can go into closing remarks. And Dan, let me ask you to take the lead on this. What should basically REIT promoters and investment banks, what should they consider when putting together a REIT offer, basically for investors or for pension investors?
Yeah, thank you, Kimashi. I think key among them is that the underlying product has to be a solid product, has to be a product that has good return, and a product that, because most investors will basically do an investment due diligence before they invest in a REIT. So that is key. Our track record is key, and there should be a clear demonstration that there's opportunity in whatever underlying product is being invested in. And hopefully, the tax incentives that we've talked about REITs, the stamp duty one, hopefully the Kenyan legislation will be able to take care of that, and REITs will be much more tax efficient than they are at the moment. Those are key things that promoters should look at when bringing a product.
Okay, thank you for that. And maybe Ewart, you can add. So let's talk about alternative investments in general, because this is your area of expertise, I believe. So why should fund managers and institutional investors focus on alternatives? Okay, alternative investments in general.
I think it's just really the risk and return, the diversification conversation comes in here, And I always say this, that for the last, at least in Kenya, for the last 25 odd years, we've simply invested in government securities and equities. One is allowed to go up to 15% now offshore. And I kid you not, within Kenya, just less than 1% of assets is offshore. So whilst, in as much as these asset classes do exist within the regulations, we don't, as fund managers, take advantage of those asset classes. And I think it's testament to the regulator today, both the RBA and the CMA, for having given the fund management community the leeway to actually invest within these catchments, these different asset classes. So I think diversification is key, but I think on the sell side, really, it's for sell side to convince buy side why this is necessary. If you really are a promoter and a good investment bank, you should demonstrate why going into an alternative it makes sense. What are the returns on that? What are the investment grade? And at the time of structuring the product, and to Dan's point earlier, always consider what buy side wants. I sometimes find that investment banks will just put together a product, then go do the roadshow, and then guess what? Buy side's not interested. Well, did you bother to do your due diligence as to what Dan, for example, who manages the largest fund in the country, what does Dan want? What does Dan want? And that's very, very key. I think and if I can, in terms of, since we're about to closing remarks, what I can say about where I'm seeing the capital markets today in Kenya is that the regulators this time actually are working with both sell side and buy side. The regulators are very keen on market development. And that for me is a really positive sign to see. Both the Retirement Benefits Authority, the Capital Markets Authority. Just yesterday, we had a webinar with the CMA as they released their quarterly reporting. And, the CMA is doing great work on the alternative side. So to have the whole entire capital markets ecosystem within the country sort of coming together just to develop the market, I think it's a great place to be where we're at right now.
Okay, thank you, Ewart. Thank you. Now, perhaps before we are almost out of time, before we go into closing remarks, maybe Zorava can just give us a quick brief about the work of the REITs Association of Kenya now within this particular space of REITs investment.
Thanks, Kamasha. Yeah, there's the REITs Association of Kenya is there to help promote the REIT product in Kenya, and the association does that in a few different ways. One is I talked a little bit about this REIT Toolkit and Incubator program that is specifically targeted at new REITs coming to market, and also the service providers that are linked to REITs, helping them understand, what are some of the tools and resources that bring them to market. But there are also several other programs that run at the REITs Association of Kenya. One is on policy. So we were talking about incentives and tax incentives. So through the REITs Association of Kenya, working with its partners of KASIB, the Nairobi Securities Exchange, Fund Managers Association, is actively lobbying for tax incentives. So for example, right now, we're most active on the stamp duty issue and also on the CGT issue as well that relate to REITs. And so that's something that we're actively involved in right now, and we're working on updates to the finance bill as well. We also do research as well. So today, for example, we launched our 14th edition of the REIT newsletter. So you can ping the REITs Association to get on the mailing list, and you can receive that, or you can go to the website and access all previous REIT newsletters as well. So there's ongoing and active research happening, and we partner with the industry, but then also with the University of Nairobi and Strathmore University on various research initiatives as well. And then, of course, events. So far, we have ongoing workshops, REIT workshops, which are training and deal rooms where we try to put REITs in front of investors as well and promote investments in the sector. We have these webinar series that we've partnered with CC on and others, and we hold an annual conference. So our annual conference will be later in the year. I think the date will be released. I think it's usually around November timeframe. And that's always a good way to get a chance to meet actors in the REIT sector and get to know people in the REIT sector and learn more about REITs. And you can always, of course, sign up as a member for the REITs Association of Kenya. Feel free to, sort of email on that email that was listed. So really just around mobilizing the product here in Kenya and trying to get more investor awareness and more product awareness in the market. Thank you.
Thank you, Zorava. Maybe very quickly, Ewart, you wear many hats, KASIB, FMA, KEPFIC. Maybe you can just give us a brief about your work now within this particular.
Yeah, really very quickly, my remit is to ensure that alternatives within this country is now an acceptable form of investment, if you will, to the fund managers. So really, we are on pushing, discussions with the RAC. So here we are with REITs Association of Kenya and Zorava. So that on the real estate side, we're pushing discussions with YAFCA, which is the East African Venture Capital Association. So getting fund managers to look at private equity, venture capital, that sort of thing. And also pushing discussions with KEPFIC, which is the Kenya Pension Fund Investment Consortium, so that pension funds can look at infrastructure funding. And that's, again, another huge discussion to be had. So 3 different tracks, if you will, and it's slowly moving. If we can get fund managers by the end of this year, next year, putting a few $1 million into the alternatives, then I can say we've at least started, on that work.
Okay, thank you, and still on you. Let's now go into closing remarks or call for action. Let's start with you, Ewart. Just very brief about the topic at hand.
Yeah, look, I think it's a great topic. I do have to give credit to Zorava on, he's here. It's the courtesy of Zorava that a lot of this work has moved within this country. So, thanks to Zorava, this work that we're doing, whether it's real estate, investment trust, or whether it's private equity, or whether it is KEPFIC, all requires people to literally push the envelope and keep pushing and never get discouraged, because we've been at this for what, almost 10 years now. You know, I think Zarab has been around for 10, 12 years in Kenya doing this work. It's just been really going strong just pre-COVID and, you know, after that. And you will not get movement within the African capital markets if you don't push and really start educating and sensitizing people to these asset classes, or these different asset classes. You know, we cannot keep investing in government debt and equities for 20, 25 years. I mean, that's all I've done in my career, government debt and equities. I mean, how sad is that? I would hope that by the year 2050, we're having a different conversation, right? And we're saying we're doing vast amounts in REITs and vast amounts in infrastructure and amounts in private equity and venture capital. That would be a great conversation to have 15, 20 years from now. So at least we're starting the good work. I hope it can continue, not just within Nairobi, but within Kigali, within Kampala, within Dar es Salaam, within, you know, Harare, wherever, Accra, Lagos. That would be great. And we can foster interdependence and learning within the sub-Saharan continent.
Okay, thank you, Dan. Brief closing remarks.
Yeah, just to say that, I mean, the interest within REITs is high as long as the right products come along. And it's an industry that, you know, I'd like to grow. And probably an interesting fact for those who might not know, probably most of us associate REITs with your normal brick and mortar building. But one of the largest REITs in the world is actually American Towers. They do sell infrastructure. So, I mean, it's a space that hopefully, I mean, that's a good underlying product. And hopefully we will get more and more of these products. So yeah, like Ewart has said, to hoping to more assets for investors and good quality underlying assets. Thanks.
Okay, thank you, Dan. Zorava will close the event with your closing remarks.
Thanks a lot. And Ewart, thanks for the positive words. I didn't pay him to say that, so but I appreciate that. And yeah, no, it's you know, it's been I think a lot of market actors are coming together, like the regulator. Now we're seeing associations like KASIB, FMA, really working to push products like REITs forward. And it's great to be collaborating across the entire sector. Yeah, my only really closing remarks is that there's money to be made here, you know, whether it's talking about the AUM, whether it's talking about the over 30 billion potentially in REIT management fees, the 20 billion in transaction fees that investment bankers could partake in, and the tens of thousands of jobs that will be created. There is a lot of social and economic development that comes with REITs. And at the end of the day, you know, what are we talking really about? We're talking about property portfolios that are publicly traded. And really it's as simple as that. And people understand property, people understand the exchange here. So we really think that REITs are ripe to take off. So feel free to reach out to us anytime. And we're supportive of market growth and really appreciate Ewart and Dan for coming on today to talk about it from a fund manager's perspective. Kamasha, yourself at CC to really create the platform for us to be able to share this information about the REIT product. So thanks so much, and all of you who came to listen to us today. So thanks so much, Kamasha.
Okay, thank you. And with those closing remarks, we may close this particular event. Unfortunately, we're going to be we got many questions. Unfortunately, we're unable to go through all of them. But once again, it's certainly been a great honor and pleasure hosting you all today. Let me thank our panelists, Ewart, Zorava, and Dan for their very valuable and informative input and insights into this topic of fundamentals of REITs investment. And a big thank you also to KASIB, the FMA, and the REK for the partnership in this particular event. We hope to see you again on the 16th May. So for the second part of the REIT series, where we'll be discussing REITs management. Okay, so see you then, and thank you again.